Welcome to episode number 52 of The Rent Roll, your podcast on all things rental housing, apartments, SFR, and BTR. Today, we're diving deep on single-family rentals and build-to-rent. We're going to share the latest data on SFR and BTR trends, specifically on leasing and rents. And the punchline is that the headline narrative isn't exactly correct. A lot of people, I've talked about this before, a lot of people think that just because home sales are weak, everyone must be flooding into rentals, specifically single-family rentals, since they're a closer alternative to single-family home buying. But it's just not that simple. It's taking longer to lease out a vacant SFR home today. Rent growth is more muted than at any point in 7 years. Still a lot better, by the way, than apartment rent growth right now, given the bulk of the supply is concentrated on the multifamily side. But rent growth has slowed in SFR, even as home sales have slowed. And many of you have heard me say this before. Many of our guests have said this as well. But the two are more correlated than most people think. A rising tide boosts all ships. Now, of course, SFR and rental housing more broadly, it also has a much higher floor than the more volatile homebuyer market. The market is still holding up well. Healthy occupancy rates for the most part, low turnover, inflationary expense pressures have mitigated a bit, plus a big slowdown in BTR construction starts, not to mention, of course, a very favorable outlook on demographics and demand. So we're going to dive into all that and more with lots of data. And then we'll welcome in Scott Eisen. He's the Chief Investment Officer and Executive Vice President at Invitation Homes, one of the big two single-family rental REITs. Scott and I are going to talk shop on SFR myth-busting. I'll ask him about how much he really looks at the MLS for buying homes these days and how those opportunities compare to what Invitation Homes is doing on the new construction side with their partnerships with Homebuilders. And we'll talk about what are those about all the challenges we hear about among home builders and what that means for Invitation, meaning like, are they seeing better opportunities to buy from the home builders today, given the challenges home builders are having to sell homes to individual buyers in today's high rate environment. And we'll talk about what markets Invitation likes for the long term, much more. So stick with us for that. It's going to be a fun conversation with Scott. All right. Before we dive in, I want to give a big shout out to our sponsors. First and foremost, thank you to JPI. JPI is a leading apartment developer with the stated purpose to transform building, enhance communities, and improve lives. JPI is a top builder in Southern California and in Texas, expanding to the Southeast and Pacific Northwest. And also a big thank you to Madera Residential, a leading apartment owner and operator in Texas, and also expanding into the Southeast. All right, so we kick it off with here's a chart, and we got a bunch of charts for you today. And I want to start off with these indices from John Burns Research and Consulting that they released earlier this month. It's based on an expansive survey the Burns team does of SFR players. And by the way, John Burns has done the team there has really done a great job on SFR and BTR. People ask me all the time about data sources, and they're my go-to for this sector. The Burns indices are on a 0 to 100 scale, where a rating below 50 signals a contracting market. Now, all three of their SFR indices are below 50 right now. Now, just to avoid any alarm bells here, these aren't falling off the cliff by any means, but slightly below 50, indicating a modestly contracting market so far in 2025. Now, the first one is on leasing activity versus seasonal norms. The most recent one covers Q2, and it scores at a 48, compared to a 50 last year and 61 2 years ago. So that means that leasing activity isn't great, but it's not terrible by any means, just slightly below normal for this time of year. Again, even with the sluggish home sale market. Again, people think, weak home buyer market should signal a lot more leasing for SFR, but it's not the case. It never has been. Now, again, though, SFR is much more stable. We're only slightly below normal. So that's a much higher floor, but no means is it boom times either. Second index is expected leasing activity over the next 6 months. And it's basically the same story. A score of 47, which is down from 49 last year, 59 2 years ago. And so SFR owners and operators are expecting more of the same in the short term, basically. And the third one, I think this is the really interesting one. It's the critical one. It summarizes the current issue very well. It's the SFR Vacancy Property Index time on market versus seasonal norms. In other words, how long are units sitting vacant between leases, or homes sitting vacant between leases? The score came in at just 35 compared to 46 last year, 50 2 years ago. So that means there's more inventory. It's taking longer than normal to lease out a vacant home. And remember, a vacant home generates no income while costs continue. So a longer time market puts pressure on operators. And we're seeing this because, first of all, we're seeing still an increase in inventory on the market. So there's more competition. It's the growth in inventory from this survey is actually down from last year, but it is still trending up a bit, and especially in certain parts of the country, like the Sun Belt. But then the other thing is so there's more competition. Demand hasn't necessarily picked up to keep pace with the supply. And so again, units sit vacant longer, and that's going to put pressure on rent growth. And that's exactly what we're seeing. That's what's playing out with rents. New lease rent growth is down to 2.6%. Now, it's still positive, 2.6%, but that's the lowest number for SFR since 2018. So 7 years. So again, when it takes longer to lease out a home, that puts downward pressure on rent growth. And that's only for scattered site SFR, to be clear. For build to rent, it's much softer, just 0.7% rent growth year over year. And of course, I'm sure everybody knows at this point, there's a lot of build to rent supply in the market. And it tends to be concentrated in the same markets and also the same sub-markets. So where there is some of it, there tends to be a good bit of it competing for a very similar demographic, often a higher income renter who's attracted to a rental community. And so that's putting downward pressure on, again, BTR rents as well. And we'll talk more about BTR supply here in a moment. Now, to be fair, for context, SFR and BTR are still outperforming multifamily, which is still wrestling with the biggest supply wave in nearly a half century. Apartment rents over the same time period were basically flat, up just 0.2%. However, I've mentioned this a lot because I think it's really important. There is a silver lining to all this for operators, and it's this. Wage growth has been outpacing rent growth for 32 straight months. That's almost 3 years. And that's true of all rental housing sectors, SFR included. And while we've seen some cooling of late in the job market, we're still seeing above normal wage growth, most recently at 4.1% year over year, according to national data analyzed by the Atlanta Fed. They have a really good wage tracker you could find if you just Google Atlanta Fed wage tracker. Really, really good data. You could break it into different kind of cohorts as well. So when wages outpace rents, that widens the demand funnel. So long term, that is a win-win. Short term, it is a more challenging environment. Now, before we move on from this topic, I want to dust off one of my favorite charts. And I've talked about this before. And I teased this earlier on as well. It's one of my favorite Mythbusters. It's the relationship between SFR rents and home sales. So again, conventional wisdom, headlines, they say SFR does better when people can't buy homes. But the data tells us otherwise. As home sales have slowed, rent growth has slowed. By comparison, in 2021, home sales hit their highest levels since the lead up to the Great Financial Crisis. But you know what else peaked in 2021? SFR rent growth and apartment rent growth too. And we saw this relationship throughout the 2010s, even in the early 2010s. We had the foreclosure crisis, more demand for rentals on the SFR side, and yet there was very little rent growth in those early years. And rent growth didn't really return until the mid-2010s, back when home sales started to rebound as well. Why? Again, a rising tide boosts all ships. That's why I always tell investors, rental housing investors of all types, they should be cheering for a healthier for-sale housing market. Now, of course, we can't ignore the fact that it is a lot cheaper to rent right now than be a new homeowner. Okay, everyone talks about this all the time. It comes up on all the earnings calls. I'm sure every SFR investor is sharing some version of this data set with their LP investors and lenders, other partners. Right now that premium is about $1,600 more per month for an apartment renter, and about $900 more per month for a single family renter. Pre-COVID, it was about $600 for apartment renters and closer to break even for SFR renters. So that's not insignificant. But in terms of an impact, the data suggests the big impact is not so much to the new demand. I think more likely we're just seeing new household formation slowing. meaning like there's less net new demand. But the real impact is on the retention side. Renters are renting longer due to the cost of home buying. So that, of course, has an impact as well. And so when we look, and that plays out in low turnover numbers. And yes, we do see that play out there. But even that, I think it's a little more nuanced than maybe the narrative suggests. Okay. So here's a chart from John Byrne showing turnover among renters and the SFR REIT properties. And that number was most recently at just 25%. This is total turnover. But if you are assuming that turnover just dropped off when mortgage rates jumped, you'd be wrong. In fact, turnover has been trending down consistently for a decade, both for apartments and for SFR. And we see that in this SFR chart. It's leveled off around 25% these last few years, which is very low historically compared to pre-COVID levels. But in 2021, I remember I said that's when home sales peaked for the last 15 plus years. We also saw SFR turnover at 24% that year. So it's about the same now as it was when home sales were peaking. And so, obviously, I still think people are renting longer. But it's a good reminder that while renters are likely to rent longer, it doesn't always mean they're renting with you longer. They can still move. They might just end up at another rental. But also, I think, turnover is just structurally lower today than in cycles past. So there are clearly other factors at play beyond home buying trends. I think we just gloss over too much. And that could be, improved product, better homes, better management, better technology. Certainly much easier. There's more conveniences today of being an SFR renter than there were in the early years of this product. Reduced mobility could be a factor as well. The recent slowing of the job market, all of these things play a role. And I don't think, so in other words, I don't want to dismiss entirely the impact of a weak homebuyer market because obviously it is a factor. At the same time, though, I don't think it's appropriate to get, or accurate, I should say, it's not accurate to give the homebuyer market all the credit or all the blame for whatever happens in the SFR, BTR, and multifamily spaces. So much of housing analysis in our country is viewed through the lens of home ownership and the lens of a homeowner. And I tell people all the time is if you view the rental market only through the lens of a homeowner, you have a skewed view and you're missing the bigger picture. So again, let's not dismiss what's happening in the homebuyer market, but clearly there's a lot more going on here. And I think that's important for long-term investors. All right. I mentioned BTR supply. Let's talk about that for a moment before we move on. Here's a chart showing BTR deliveries in the next 12 months compared to the prior 12 months by market. And just like apartments, BTR is very elevated right now, peaked in 2024, still high this year, but it is about to plunge everywhere, down more than 50% over the next year in most of the key BTR markets, nearly all the BTR markets, Dallas, Phoenix, Charlotte, Raleigh, Orlando, Houston, Tampa, Nashville, Riverside, et cetera. We could go on. Atlanta is more like, I think that's about 30-something%, but still a significant drop off. So that's going to be the big story. The supply story is going to quickly shift in 2026 for BTR and for apartments. But at the same time, here's the kind of the fundamental case for SFR. I don't think it's just about homebuyer trends. I really don't. I think I will always make the case that I think too many investors focus too much on that. And by the way, the problem with that, so circle back on it, is if you tell your investors that that's what it's all about, then what are you going to say when the market shifts again, when all of a sudden it's more, eventually this will happen. I don't know if it's be next year, 5 years from now, 10 years from now, but at some point that the big discount to rent versus buy will change. It'll erode. The cycles happen. So how do you explain that to them? Well, instead, what I would say is, hey, look, that the homebuyer market today is providing a higher floor. It reflects the higher floor performance. We're seeing low turnover, high stable occupancy, but we also see reduced rent growth. Historically, when we see more home sales, we have more move-outs. We're backfilling those units faster and at higher rent. And so, in other words, if I'm talking to my investors, I'm saying, look, we can do well in either cycle, but the real upside is in a stronger economy when homes are selling. Okay, but then going back to the real driver, I think for the next 10 years plus, it's demographics. It's the demand tailwinds here are very good as long as the economy holds up, of course. And that's always a big if, and we always have that caveat, but the demographic trends are very favorable. Here's a chart showing population by age. And look at that core SFR demographic. We know that demographic. They're late 30s into their 40s. There are 3.4 million renter households today between the ages of 35 to 44. That's the biggest among all age cohorts. And there are another 3.3 million behind them, currently ages 25 to 34. So that's 7 million combined renter household. That's a lot more than they have in the older cohorts. And even in the broader population, we know that our peak population is going to be the early to mid 30 somethings, that they're going to be more and more aging up into the prime SFR age. Now, of course, some of these people will eventually become homeowners. I don't want to downplay that because, again, everything's cyclical. But it's still going to be a sizable demographic, and it's not just the change in homeownership that's impacting this. People are also just, even before the spike in the spike in mortgage rates, we saw a shift, people waiting longer to get married and have kids, and they value flexibility more than prior generations, which favors renting. And so there's other structural drivers that go along with these positive demand drivers, demographic drivers. And I think that's the key story for the next decade, not what happens in the home sale market. And by the way, the John Burns analysis data of census data, their analysis of census data, it also shows there are nearly 4 million SFR households today with incomes in the 100,000 or more. So that's a big pool of folks for whom, generally speaking, rental affordability is not a major hurdle. And that's typically demographics served by the SFR REITs and many of their institutional peers. So that's a big, big factor. And I think it's going to remain a big story through the next couple of cycles. All right, let's shift to our next topic, rental housing trivia. All right, today's rental housing trivia question is, factoring all in monthly costs, when was the last time it was cheaper to be a new home buyer than an SFR renter in the US? And I'll give you 5 choices. Was it 2002, 2009, 2012, 2018, or was it 2021? Okay, so think about that, and we'll give you the answer here in a bit. Next up, in the news. Okay, in the news, this is when we look at headlines that touch on issues that impact multifamily and single-family rentals and renters. So we got a mix of headlines this week on different topics. The first one, the big one, comes from the Federal Reserve's meeting last week, and the Fed cutting the federal funds rate by 25 bips. Okay, so afterward, the Fed Chairman Jerome Powell spoke for 1 hour. He answered about 35 questions from reporters. And I thought it was really interesting that housing comprised just one of those 35 questions. And I shared this on LinkedIn. I said it's a humbling reminder for those of us in the housing and real estate business that as much as we obsess over Fed decisions, it's probably the top 1 or 2 question I've been asked about in these last 2 years is if I really know what the Fed's going to do, because I joke about this all the time. Even the Fed doesn't know what they can do. Their dot plot charts have proven to be very inaccurate as they forecast future decisions. But we all think about it. We talk about it. And when we see it's one of 35 questions, it's a humbling reminder that real estate is just a small piece of the many factors the Fed considers. So let's dive into that one question he answered. He was asked by a Barron's reporter about how high rates are exacerbating housing affordability issues. And he had a kind of a good answer here, a nuanced answer. And one thing he said, he clarified a comment he made from July. And back then he said, there's a long-term housing shortage. This is not something the Fed can help with. And when he said that, I don't know if I shared this in the podcast or on social media, but I'd been critical of that comment because I do think that Fed policy plays a role. The cost of debt plays a role in construction. We know that. But this time, Chairman Powell spoke in more detail on the topic and gave us a little more nuance how he was thinking about it. He acknowledged that rate hikes, quote, does burden the housing industry, and that rate cuts, quote, will help supply. But then he also added, quote, most analysts think that it would have to be pretty big changes in rates to matter a lot for the housing sector. And I think he's right. And then he said, quote, there's a deeper problem here that is not a cyclical problem that the Fed can address. And that is just, it is a So let me say it again. And that just is a pretty much nationwide housing shortage, or a lot of places in the country just don't have enough housing for people, end quote. Now, again, I'd been critical of his comment in July that the Fed policy couldn't address the housing shortage, but I see now what he was trying to say, that rate decisions do impact supply a lot. But he seems to be suggesting that no matter how much they cut rates, it wouldn't be sufficient to fully address the structural housing shortage, especially at the lower, most affordable ends of the market. And that does make sense. I agree with him on that. Now, as far as the impact to multifamily and BTR, I don't think anyone thinks a 25 bips cut is going to open up the floodgates by any means. Now, the Fed also did signal 50 bips of cuts later this year. That could be more impactful, that signal. However, once again, I'll point out, the Fed has proven to be very bad at forecasting its own future decisions. We all like to look at those dot plot surveys, but they're just not especially predictive, unfortunately. So barring much larger cuts, I think that quite obviously the big needle mover for apartment and BTR construction to get going again is not necessarily rates, but rents. Rents need to rebound first. I think developers and their equity and debt partners need to know, today we don't have a good understanding of what's that market rent going to be when you deliver, because there's been too much, high use of concessions, the, leasing challenges with high supply, units taking longer to lease up. We need some stabilization first in occupancy, then in rent, to have a better understanding of what you're building to. And of course, friendly reminder, the 10-year Treasury matters a lot more for this industry than the federal funds rate. The two are obviously correlated over time, but they are different. And it's worth noting that the 10-year Treasury is actually up since last week, ironically. And there are probably a lot of reasons for that. But, at the end of the day, I think there's just a lot of noise when you look at, daily movements in the Treasury and the stock market as well. All right, next headline. Huge deal. Kennedy Wilson to acquire Toll Brothers apartment living platform for $347 million. All right, so Toll Brothers, the big home builder, they are exiting the apartment business, selling its platform, including the leadership team and development pipeline sites, to Kennedy Wilson, which is a institutional investor, shifts $5.2 billion of assets under management to Kennedy Wilson. Now, according to their website, Toll Brothers Apartment Living only has 2 projects in active development right now, but they do have a bunch in leasing all across the country, and they really are coast to coast, Northeast to Mid-Atlantic to Sunbelt to West Coast. They've got a Midwest presence as well. They do urban and suburban, also student housing. So they've dabbled in a lot of stuff, a lot of different markets and different product types. The deal includes Toll Brothers apartment pipeline of 29 development sites, as well as the in-house development team. So that immediately makes Kennedy Wilson a major player in the apartment construction business and operating business as well. So many of you know Lennar previously sold off a big portfolio of apartment homes under its Quarterra brand. Now Toll Brothers is exiting apartments altogether. So what's going on? Well, Toll, in their press release, they said that they wanted to be more, quote, asset light. Okay, so what does that mean? Well, remember that a typical new apartment project, the institutional level apartment project that they kind of do, these are projects that are worth easily 100 million plus. Okay, so it's obviously much higher than building a typical single family house, and more debt and equity needed, more complex capital stack, more variables. I think very importantly, there's more variables on when and how it gets sold compared to an individual house. So that locks up a lot of capital, sometimes longer than they may want. And that can have implications for a publicly traded company. These big home builders are publicly traded companies. And so, if a big transaction worth 100 million plus gets delayed by one quarter, that could impact your quarterly results. So this sale gets told back to their core business. Now, a related factoid I thought was kind of fun to share here. One of the Toll brothers is not out of the apartment business altogether. Bruce Toll runs a group called BET Investments, which builds and operates different types of real estate, including multifamily. And I'm not entirely sure why that was always separate, but I'm sure that he had his reasons. All right, next headline. This one comes from CNBC. More consumers are using rent payments to boost their credit score. Here's what to know. And I'll read a little bit from this. It says the share of consumers whose rent payment are reported to credit bureaus rose to 13% in 2025, up from 11% in 2024, according to a new survey by TransUnion, one of the three major bureaus. Well, look, I mean, if your rent is your largest expense, now wouldn't you want credit for paying it with the credit bureaus? So to me, it's good to see more renters taking advantage. I think it's a win-win. I think every property manager should be promoting the service because it not only helps with their customers, which are the renters, but I think it's good for the bottom line too. It's in your own best interest. And, I know some people say, well, it's just positive outcome only. I mean, we only report when payments are actually made, not when they're not. But even still, it's an incentive to pay rent on time. Pay on time, get credit for it. It's a win-win. So I hope that continues to grow. All right, and we're going to go across the pond for our last headline of this week. It comes from BBC, and the headline says, "I've sold my flat before the renters' rights bill becomes law." So in the UK, where they're nearing passage of what they call the Renters' Bill of Rights, I'll tell you, they name these things so they're so well branded. It's kind of like good cause eviction. It's deceptive what it actually is compared to the name, and it doesn't necessarily have the impact that in long term that's supposed to have. And this is a very well named bill, but I think UK legislators are about to learn another lesson about the law of unintended consequences. So this bill would, according to the BBC, ban no-fault evictions and allow tenants to challenge unfair rent increases, among other things. So first of all, a ban on no-fault evictions, that sounds good. I think every renter would like that. But the real issue here is that the owner no longer has a right to control the property. The renter now effectively has many of the benefits of ownership, which includes security and semi-permanence, but without the burdens and costs of ownership. Second, can you imagine the Pandora's box of allowing tenants to challenge, quote unquote, unfair rent increases? So, what is unfair? Who gets to define it? What is fair to one side may be unfair to another side. So again, the property owner loses control of the property they own. And put it together, in the US, this might be what we call a taking, or at least, a violation of the Constitution, at least more in theory than in practice, given what we've seen to happen in places like New York City. But here's the bottom line. It's no surprise to see a headline like this, an article about this, that property owners are selling their homes. You may not be able to sell later because the market to buy rental homes you can't control is going to go down. They're less liquid. Presumably, you can't sell it to an owner-occupant because I'd assume the renter in place could veto that as a no-fault eviction unless there's a carve-out for that scenario. So here's the unintended consequence. Rental property owners are selling their homes in the UK before the law goes into effect, and that means there'll be fewer rental homes on the market. Now, if you're a buyer, you think, hey, that's a win. But who are the buyers? Well, they're generally wealthier people with more cash. It's a big loss, though, for renters, those who want to be or need to be renting, who now have fewer options available to them, which means that their costs are only driven up more and their available housing is only driven down more. So the needy are impacted most negatively. So again, we got to think 2 and 3 steps down the line when we put policy together. For every action, there's an equal and opposite reaction, and the consequences here are just not that hard to figure out. We got to do a better job wherever we are in the world. We got to do a better job to really protect renters in need. This won't do it. It's going to inevitably backfire, like we've seen from similar measures here in the U.S. All right, let's come back to rental housing trivia. The question this week was, factoring all in monthly costs, when was the last time it was cheaper to be a new home buyer than an SFR renter in the U.S.? So I give you 5 choices. Was it 2002, 2009, 2012, 2018, or 2021? The correct answer is, drumroll, E, 2021. According to John Burns Research and Consulting, the last time this happened was in February of 2021. By March, the tables had turned. By 2022, it really soared as home prices and mortgage rates jumped. But interestingly, it was cheaper to be a new home buyer from June of 2019, so pre-COVID, all through 2020 and into the first 2 months of 2021. The discount to buy versus rent peaked in July of 2020, $120 a month. That's a lot of 20s. Let me say it again. The discount to buy versus rent peaked in July 2020 at $120 a month. So 5 years later, let's compare that to July of 2025. It's now $881 more expensive per month to buy versus rent SFR when counting all-in monthly costs. So certainly the tables have turned. And by the way, for apartment renters, it's about $1,600 more per month to go be a home buyer. And that's going to take us to today's interview, sponsored by Funnel, the AI and CRM software trusted by 4 of the 6 major REITs and many leading operators like BH and Cortland. To learn how Funnel can help your property centralize operations and automate everyday tasks, visit funnelleasing.com. Today's guest is a former investment banker and now the Chief Investment Officer at Invitation Homes, Scott Eisen. Let's dive in. All right, now we enter the interview portion of today's podcast, and I am honored to welcome in the Chief Investment Officer and Executive Vice President at Invitation Homes, Scott Eisen. So, Scott, thank you so much for being with us today.
Thanks, Jay. I'm really, really glad to be here. Thank you for inviting me.
Absolutely. So, Scott, you obviously had a long career in investment banking prior to joining Invitation Homes, but give us some of your background. How did you get into SFR and Invitation specifically?
Sure. Well, when I graduated college, I actually grew up in Bethesda, Maryland, and I was surrounded by politics my entire life. So when I graduated college, my first job was working as a volunteer on Bill Clinton's campaign for president in 1992. So I spent my first year after college working as an advance man traveling the country. After that, I ended up working at the Commerce Department as a legislative aide, and I did another 2 years in the first administration. But after that, I decided I wanted to, go into business and start a business career after that. I actually read Liar's Poker in my dorm room my junior year in college. And I was always intrigued by going to Wall Street. And so I went to Wharton, I got my MBA, and I was fortunate enough to be hired into the real estate investment banking group at Merrill Lynch in the late 90s. And for those of you who recall, like a lot of the early REIT IPOs, Merrill was the lead bank that took a lot of those companies to market. And so for me to have the opportunity to work with Richard Saltzman and the original, managing directors and who worked on a lot of the original REIT IPOs, I was able to be part of that team. I worked there for 8 years, and then I switched to Citibank. I was a real estate investment banker at Citibank for another 18 years. What was really interesting is while I was working in the industry, I was able to be part of the rise of a lot of the alts REIT IPOs. So when the self-storage REITs went public, when the student housing REITs went public, and eventually the single-family home rental REITs. And so I was able to be part of that growth of the alternatives real estate sector. And it was fun for me to be, a banker advising and raising capital in space and learning about all these new businesses. And then Dallas Tanner, I actually covered the company as a banker. Dallas actually called me up because I actually have Dallas's old job. So I'm the Chief Investment Officer at Invitation. And so Dallas called me up and asked me if I wanted to have an opportunity to be part of the team. And I jumped at the opportunity, and it's been wonderful working with him and the team and helping grow the platform.
Yeah, that's fantastic. So you had a relationship there previously. So you stepped into an industry that, as you will know, there's so many conspiracy theories and myths. And I consider myself, I'm a researcher, but I also think a lot of my job is I'm a mythbuster. And so I love these topics because I think a lot of times the conventional thinking is so far from reality. So I want to ask you, there's many to choose from, but if you can magically dispel one of the false conspiracy theories and myths about institutional SFR REITs, what would it be and why?
Look, I think there's really two myths, right? The first is this myth that institutional owners represent, a huge percentage of the owners of single family homes. The reality is we represent a very small fraction of the housing market, less than a few percent. The real conversation should really be about expanding access to housing, not blaming any individual tiny group that supports the market. What's really driving housing challenges are the high mortgage rates and high insurance rates that are putting home ownership out of reach for the average American. And so renting is not only a practical option, but it's the preferred one for people who want the benefits of living in a single family home without the upfront costs and the long-term obligations. I'm sure you've done this on your prior podcast, but we have to keep reminding people that the cost to rent a home is on average about $1,000 per month less than the cost of ownership. And so far from hurting the market, we're actually contributing to a healthier and more dynamic industry.
Absolutely. And I'll say as an aside too, I was at an event last week in New York, and there was a researcher presenting that that the institutional investment in SFR has also helped diversify neighborhoods with people who otherwise wouldn't live there. And I think that's an important factor as well that you and your peers do as well. So one of the other things these myths we hear about a lot is that, hey, companies like yours are buying all these homes off the MLS. So I'm just curious to ask you, how many homes, approximately does Invitation buy these days off the MLS? And how much are you even looking there anymore?
Look, I've been here 2 years now, and I think less than 5% of our total acquisition activity has been on the MLS the last 2 years. Okay. So in terms of us and our market presence, we've really leaned in on helping buy and finance the construction of new homes.
Yeah.
And so when you look at where we've been buying and how we've been buying, it's been buying from the national home builders. It's been buying from the regional home builders. It's been buying from some local developers that are building, these BTR build to rent communities. And so we have really leaned in on the new construction product. It's creating new supply. It's a lower capital investment for us long term because obviously you're getting a brand new home and it doesn't have the wear and tear of a 20-year-old house. And so this is really where we're focusing our investment and acquisition opportunities nowadays. We obviously pay attention to the MLS, where homes priced on the MLS, where single family home rents are in existing homes. It's obviously a factor that we take into consideration with every acquisition and investment that we make, but it's really not a focus of our investment activity today on the MLS.
Yeah. So I want to dig into that a little more. Like, why is it, and you're not the only one. I mean, your peers will say the same thing. So why, for institutions, does buying off the MLS not make sense? It's just not as efficient use of capital. Is it, less harder to scale that way? I mean, what are the reasons why it's not attractive to you guys?
I mean, look, there are institutions that buy on the MLS. We will always buy to a certain extent on the MLS. But the reality is when you're buying an MLS home, it requires a substantial amount of capital investment, right? Because you're buying a house that might be 20 plus years old and it might need a new roof or new countertops or new appliances in the kitchen. And we're a publicly traded company. We have a certain return on cost that we have to get for our shareholders. And when we look at where homes are trading on the MLS from a yield on cost basis right now, it just doesn't really meet the hurdle rates we have as a publicly traded company.
Yeah. No, I make this point a lot in some of my commentaries, but if you look at the last 10 years, there's been an increase in home ownership in the US, and that directly reflects the fact that homeowners are outbidding investors by and large for housing, because for them, the house is not an investment, it's a home. They're willing to pay more for a home than an investment. So I think,
I have a friend in New York who was trying to buy an apartment a few years ago, and he was trying to calculate the cap rate that he was buying his apartment in New York. I said, don't do that. That's the wrong way for you to think about your personal investment.
absolutely. That's a great story. All right. So Invitation, and y'all have been talking a lot about recycling capital, and we hear the apartment REITs talk about this as well. And for those listening, this refers to selling older properties, building or buying brand new ones or relatively new ones. Can you walk us through that math? And you've alluded to this already, but walk us through that math of why it often makes sense to sell older homes and build or buy a brand new one.
Sure. Look, when I was a banker, capital recycling was part of the capital allocation plan of every single publicly traded company that I work with.
Yep.
As their advisor. I think pretty much every REIT that trades in the public markets, we are permanent capital vehicles. We invest for the long term in real estate. I think everybody, when they look at their portfolio, probably has 5% of it that they could recycle into new investments. When we look at our company, I have a team that evaluates all the homes in our portfolio, and we look at a number of factors that we determine in terms of capital recycling. It may be the age of the home. It may be a market where, we're seeing slowing growth rates. It may be a market where we're subscale. There are a number of factors that go into our decision on how to recycle capital. But at the end of the day, we have a number of homes where if we can sell those homes in the low 4 cap rates and redeploy approaching a 6 cap in markets where we're buying new construction with good long-term fundamentals, that's an appropriate way of allocating our shareholder capital and generating higher returns on investment for the publicly traded company.
Yeah. So let's get into a real life example. In your last earnings call, the example I believe you or Dallas gave was you're selling in Southern California older homes, building new ones in Atlanta. So is it fair to say that's generally a strategy to sell in these slower growth, higher regulation markets like LA, build in the Sun Belt, or are you doing the same strategy within the Sun Belt markets too?
Look, I think the capital recycling strategy is generally market agnostic. We have sold probably on average about a third of our homes over the last few years in California, but it's been more about looking at, the age of the home, the gain on sale that we have on the home, what kind of return we can get. I have a team that works for me on the asset management side, and every time we have a lease that comes up for that doesn't get renewed for whatever reason, and we have a move out, we do a rebuy analysis. We look at those homes. We determine what the market value of that home is. We determine how much capital we have to reinvest in that home. And if we think that it's a better return for our shareholders to sell that house and then go to redeploy it elsewhere, that's the fundamental analysis that we go through as a team. And so California happens to have had a very substantial amount of home price appreciation. Obviously, we get great rent growth in that market, but we do an analysis. And if we think that it's accretive to the shareholders to recycle that capital, we will.
Mm-hmm. So, would you recycle that capital? Would you recycle that capital back into California if a higher rent growth, or is it still more accretive to go to a higher growth market?
I think we take all kinds of things into consideration. California is a great rental growth market, but it's very expensive to build there, right? And so because of the cost to build, you may have to look at a going in cap rate that may be a little too low to justify the return. California may have higher longer term growth, but it's probably a very low near term yield on cost. And that's the balancing act we have to take into consideration on every time we evaluate an investment. We actually have a build-to-rent community that we did a forward purchase with Pulte in California that is a great investment. But again, California, just because the cost of construction, it's
Yeah.
just a higher price point home. And while we get higher rents, that cap rate ends up being low on a relative basis to other markets where we have the opportunity to deploy capital.
And I wish my people understood this. It's like, the rent is a reflection of the cost that you have to build these things. And so we have to drive down the costs if we want to have lower rent. So another question related to Scott is, when you guys sell a house, whether it's in California or elsewhere, do you have a sense for who the buyers are? Are they mostly owner occupants?
Yeah. So for us, again, in terms of our workflow on the asset management side, first we have the team that determines the rebuy analysis on a house. When we choose to dispose of a house, we have a different dispositions team that then works on executing those sales. We have a number of local brokers that we work with for our sales. We use different brokers in different markets, depending on where their expertise is, where we have relationships with them, et cetera. And in those local markets, they then put it on and we sell it to a majority of end users in the market. There are always some investors that try to purchase these homes, but when we look at our homes that are sold, on average, it's a majority to end users.
Yeah, it's interesting. So you've talked about home building. Let's get more into that. On your last earnings call, I thought the commentary that you and Dallas provided around home builders was very interesting. And for those who missed the call, you guys made the point that home builders are showing more willingness to discount on pricing for what they call excess inventory. That makes those buys more attractive. And so I'm curious, it's been a few months since that, a couple months, is that changing since the last call? And what are you hearing from your home builder friends right now?
Yeah, look, we have a great relationship with the national home builders, the regional builders, the local builders. We have always seen inventory tapes. When I started the company 2 years ago, we were receiving inventory tapes from the builders. I think the difference is 2 years ago, their gross margins were higher. I think their ability to sell to end users, it was a much stronger market. You've noticed what's happened with the spring selling season and the summer selling season, and the fact that the home builders didn't have as strong a season as they did last year. And so they were more willing to work with us on pricing. And I think the difference is we've probably seen a similar number of homes, but I think the yield on cost for us is much more attractive in today's environment than it was a few years ago. And so we've always received the tapes. We've always engaged with the home builders on it. And I think today, think about it, a production builder, if you're a national builder, if you're a publicly traded national builder, your mission is to build homes
Mm-hmm.
and sell homes. And so I think on other podcasts, you've used the word either liquidity or lubricant in terms of the role that ourselves and other institutions like us play in the market. And our ability to buy those homes from the builders, and then they can then recycle that capital into building new homes and building new communities. And so I think it's a win-win for us and the builders right now, where they have a slower season. We're finding they're willing to work with us on pricing and value. We're getting the right return on cost for our shareholders. And at the same time, they're able to continue to sell homes out of their communities and then reinvest that capital into starting the next community so they can continue to produce homes and add housing to the overall supply in America. So it's a win-win for everybody.
Absolutely. So, and then from a strategic perspective, what's more interesting both to the home builders and to you guys right now? Is it this excess inventory in existing subdivisions, or is it pre-purchase agreements on future construction? And how does that math differ right now?
Look, I think it's both. We've definitely making offers on the builder tapes right now. We just signed an agreement last week on another forward from the builders. So we are doing both right now. I think the difference is when you're buying an inventory tape, well, the house has already got certificate of occupancy. I can close in 30 days. I'm probably rented in 90 days, right? And so it's a much faster, it's faster to get that home on the market and rented to our customers. And so it's creating a feedback loop where we can know where market rents are, we understand what the value of the home is, and then we can continue to buy homes and get a shorter feedback loop. On the forward purchases, we might be buying a house that's 6 months forward, 12 months forward. So in that particular situation, we've probably got a little more control over where we're buying the house, what the floor plan looks like. Are we in the front of the community? Are we in the back of the community? Get a little more influence over the design, placement, and structure of that particular community. And so it's a trade-off. On the one hand, we're sort of picking whatever homes the home builders are showing us in buying on the inventory tapes, but it's faster to market. On the forward purchases, we maybe have a little more control in that decision-making process, but it's a much longer wait until we're able to put that house on the market, establish a market rent. And so as a result, there's just more time value of money in that forward purchase situation. And so under those circumstances, yeah, I think we'd probably require a slightly higher yield on cost because we have a longer time to wait until we're actually bringing that home to the market.
That makes sense. And so, the home builders have been in the news these last few weeks. Some of them are pulling back a little bit. I mean, do you think that groups like Invitation will play a bigger role? Meaning, are single family rental operators, owners, are you more interesting to them right now as they look to stay busy?
It's funny, when I joined, that was my discussion with the builders, which was, hey, we're really interesting to you because we can supplement your existing home sales. Dallas has an analogy he likes to use where if we were a car manufacturing company, the auto manufacturers, they sell cars to individuals who buy those cars, but they also do fleet sales to Hertz or to the United States government. And so we view ourselves as just being a supplementary source for the home builders, where they're never going to stop selling homes to end users. But if we can continue to work with them and provide liquidity to them and give them confidence to start more communities over time, a builder may look at a community and they may look at a particular submarket where the pace of sales may require 5 years for them to sell out a community. And if we can work with them to buy some percentage of that community and reduce that time frame from 5 years to 4 years to build and sell out that community, well, that then allows them to accelerate the pace of home sales. And again, it allows them to recycle their capital into building the next community. So again, we view ourselves as being complementary and supplementary to what the home builders do every day with their end user customers.
No, that makes a lot of sense. I think people outside the industry forget that, whether you're an apartment builder, a BTR builder, or a home builder, you make money by building. And so if you have more buyers, whether it's an SFR company or an individual end user, that's good for business, right? When you're not building, you still have costs, and you don't want to lose your people. You want to keep them busy. Scott, I know you've been asked this before. I was just asking one other kind of related question. Is that strategy of working with home builders, does that remain much more interesting to you guys, and actually having your own development arm and doing that all that in house?
Well, when I joined, Dallas had obviously started our forward purchase program by entering into a large forward agreement with Pulte on a number of
Yeah.
communities. And then after I started the company, we started working with other builders. I think today we have done purchases from more than 15 national and regional builders over the last 2 years. And what we realized was, as we spoke to those builders and talked to them about forward purchase agreements, we actually realized that they also had a capital need for equity and debt capital. And so as we spoke to them about forwards, part of why we started our construction lending program was because we realized there was demand from the development and builder community for that capital.
Yeah.
And so that was what ultimately led to us making an announcement in June this summer about initiation of our BTR construction lending. And so those same builders and regional builders who we initially started with forward purchases, they said, look, there hasn't been as much liquidity for construction loans in the debt markets. A lot of the banks had pulled back on construction lending. And we're in a unique position with our operations, with our market knowledge, understanding values, understanding market rents. We're in a unique position to be able to underwrite a loan for someone that's building a community that the odds are we're probably the natural buyer when that community stabilizes anyhow. And that was why we started the construction lending program. And we view that as being a way of going a little further up the chain on development, working with some local and regionals, and helping support the construction of new homes in these built-to-rent communities. We've closed on our first loan. We've got a couple term sheets out for signature. We're going to grow this over time, and we view this as being a wonderful opportunity for us to participate in that development space by being a construction lender to the industry.
Yeah, so that's interesting. So you guys can get some of the benefits of being, a developer, but you're not actually having to take on all the the hard costs, the capital costs of being a builder yourselves. So that makes sense. Can you describe a little about that program and how is it helping get more homes built?
Yeah, again, for us, we have a team that is out in the market. We speak with, we're focused on our existing markets.
Mm-hmm.
We're focused on the same product that we're buying from the builders right now: townhomes, detached 3 bedrooms, detached 4 bedrooms. And there are a number of BTR developers out there that are looking for capital to grow that business. And so for us, we just view that as being a natural extension of our business, a natural opportunity for us to help create more housing. And I think we see a real demand for the product.
Yeah, that's great. Obviously, like you said earlier, the more we build, the better for everybody. So let's shift gears, talk about the existing SFR portfolios. And I know we can't talk about any specific deals that may or may not, be coming across your desk. But at a high level, what are you seeing in the market in terms of opportunities to acquire existing, smaller, mid-sized SFR portfolios? Is there distress out there due to rates, some groups that may need an exit? And if so, what's the profile of those potential sellers?
Look, there's no doubt that 5, 7, 10 years ago, there was a lot of equity that was raised from LPs to come into the single family home rental sector. Some of it went to some of the larger players like ourselves, and some of it went to more startups that were trying to build regional operators that were trying to get to the same scale that we have. Here we are today. I think a lot of those LPs are looking for liquidity. A lot of the people that had built platforms, they're subscale platforms, and for whatever reason, they haven't been able to get them to be full scaled. Part of the reason that Dallas wanted us to get into the third-party property management business was to work with situations like this. And just for the benefit of you and your listeners, 2 years ago, we started a third-party property management and asset management vertical within Invitation Homes. So here we are today. We actually have 2 joint venture partners and 3 third-party management agreements with institutional owners of single-family homes and BTR communities. And so we view that platform as a way for us to potentially participate in this consolidation sector, where we are a scaled operator. Most people get a benefit of higher margins when they move from a subscale operator onto our platform and system. And so we view ourselves as being a solutions provider for the people that you referred to in your question. And so in some cases, it might make sense for us to buy all of the homes and platform that somebody has. But there may be circumstances where it makes sense for us to work with an existing GP or work with an existing LP and participate somehow in their partnership. Perhaps we could take over property management and make the homes and returns more efficient. Perhaps we could take on an asset management role. Perhaps we could make a minority investment in someone else's platform or portfolio. And obviously, to the extent there was an opportunity to buy someone's platform and portfolio of assets, we would be interested in that as well. And so we think by starting the third-party property management business and working with our portfolio management team, we can be a solutions provider to a lot of people that might want liquidity in today's market.
Yeah. Yeah, I think that's one of the interesting trends to watch over the next couple of cycles. You know, it's the advantages that companies like yours have in terms of operations and scale. You know, have in-house maintenance teams, instant leasing processes, things like that. It's very hard in the long term to keep up with that kind of that type of innovation. So, I wouldn't be surprised to see more consolidation in some level, even if the total share of the market is still, for institutional, still always going to be small, but more consolidation among some of those mid-sized players who just going to have a hard time competing, have a higher cost of capital, higher operating costs, et cetera. But let me go into the next topic, though. As you think about expansion, the Midwest region has been strong for both apartments and SFR, and so you guys always get asked about this. Your peers do as well, both on the multifamily side and the SFR side. Dallas was asked about in your last call, and I'm going to paraphrase here. He basically said, "Hey, the Midwest has been good, but we just see better risk-adjusted opportunities in the Sun Belt. And obviously, the Sun Belt has the better demand drivers, the growth. Plus, we're going to see less supply, less BTR supply and apartment supply in coming years. But even so, like, what do you see as the challenges to expanding further in the Midwest?"
Look, the Midwest is a great market, and it's obviously having a moment, right? Rent growth is great in the Midwest. There wasn't as much new construction of homes. It wasn't at least as much of a beneficiary of the net migration to the South that started 5 years ago during COVID. But at the same time, I think the Midwest is a great market. We are a scaled operator, right? And so for us, we have a very substantial presence in our 16 markets. And so the Midwest is a great market, but for us to enter a new market, we've got to have a path to 1,000 homes in that market. And so we evaluate new markets every year. I have a team that works here on looking at new markets, trying to decide, can we get into that market? But we also have to have a path to get into that market. And so as an example, Nashville. Nashville was a market that we had exited before I joined the company. We had discussed that as being a new market for us to get into, or at least get back into. And when we took over the third-party management agreements for some of our customers, we realized we now had a scale in that market. We now have 1,000 homes in Nashville, and we've started buying in that market again, right? We've bought some stabilized communities. We've bought some new construction homes from the Homebuilders. So for us, it's about identifying markets where not only do we think that there's outsized returns over time, but also a market where we have a path to getting to scale. And so for us, it's really just focusing on the markets we have today, but also looking for new markets where there's a path to scale in the near run.
And so just at a high level, I'm curious to ask, when you guys look at new markets, your team's doing this, like beyond the path to scale, like what are you looking for? Is it particular types of demand drivers? Is it characteristics with the economy? Like what are those boxes?
It's the same drivers that everybody else looks at. It's population growth, it's income growth. And in our particular case, it's probably a minimum population in that market.
Yeah.
Right. Because again, for us to have scale, it also has to have a minimum population. So there are some wonderful markets out there that other people might call secondary markets that we're not necessarily in, but it's as much about the fact that, if it's a population under 1 million people, that's probably a market that's a little harder for us to get into.
Yeah. And I want to make one last comment, and I'll let you go, Scott. But, I think when we talk about scale, I wish my people understood that when you talk about 1,000 homes, the reason that's important is because that if you have scale, your operating costs are lower, and then you could, likely build at a lower rent, which makes it more attractive. The wider demand pool, you can, it's ultimately to the benefit of the market, right? To have that scale where your costs per home are lower. Is that fair?
That's right. And again, for us, this is, if you think about the power of the platform and you think about where we've gone as a company, we're 110,000 homes today that we either own or operate on behalf of our shareholders and our institutional partners. And our job is to give as comfortable a lifestyle as we can to our residents, take care of the maintenance, take care of, everything we can to support our residents. And we think we can do it with the scale and power of the platform.
Absolutely. Well, Scott, thanks so much for your time. It's been a pleasure or it's been an honor to pick your brain, and best of luck going forward.
Thank you, Jay. I appreciate your time.
And that's a wrap on episode number 52 of The Rent Roll. Big thank you to our sponsors. Thank you to JPI, Madera Residential, and Funnel. Thank you to all of you for spending part of your week with us. And thank you to Scott for being our guest. We'll see you next time.